Hey, it's Jeff Garber, mortgage expert, mortgage interest rate guru, coming at you with a weekly interest rate update for the week of May 16th of 2022. Before I get to the update, I just wanted to make note, I speak to many realtors in our local market here on a daily basis. And the media has got everybody staying on the sidelines, it feels, because everybody's under the impression that every single house that gets listed is going to get 20, 30, 40 offers on it and go way over the asking price. And therefore, you might think that you don't have a shot at getting a home in this market. Well, I got to tell you, after talking to a lot of agents lately, their houses are getting listed, but they're not getting quite as many offers quite as quickly as they were just a few weeks ago. And I'm not saying it's everybody, but we are noticing that in the market. I think the media has done a great job in scaring the bejesus out of everybody with higher rates, high inflation, and spinning numbers that just aren't true, that the housing market's a bubble and that it's a bad market to buy in. And they're doing a great job of instilling fear and keeping people that were looking, keeping people that are thinking about looking on the sidelines, and even people that have been actively looking, they're now jumping back to the sidelines, all right? No need for that. I would not be pulling the plug yet on the housing market. All right, there are more houses that typically come on the market this time of year, and if the pattern holds that there's a little bit less activity, well, heck, you might have a chance at getting something, and it may not be a bidding war of 30 people, and you may not have to go over ask as much as you think, if at all. So the markets, they do change. Nothing actually stays the same forever. So if you are looking to buy or thinking about buying or have been frustrated recently because of the amount of offers that you have to write, I would strongly reconsider now and see what's out there. Get back with your realtor and give it another stab, because you may be surprised. You may be able to get into something, okay? So let's talk about rates. Let me get out of the way here. So if you follow my videos from week to week, I like to share with you that mortgage rates come from the bond market. And what you're looking at now are 30-year fixed mortgages trading in the bond market, and they are called mortgage bonds or mortgage-backed securities. And the bond market has an opposite relationship, meaning as bond prices go down, which you've seen happen for the majority of this year, that really means mortgage rates are going up. So as bond prices go down, rate goes up. Well, we've had that predominantly for the most part of the year. And although we still are theoretically in an upward trend in mortgage rates, it has slowed. It's not as volatile as it was back in March. In other words, we blew right through the fours pretty quickly in the month of March. But April, May, the losses haven't been as significant or happening as quickly. And right now, as I say each week, as a disclaimer, the information that I share is not a rate quote. If you need or want a rate quote, please reach out to either myself or a local professional that is able to give a quote. However, most of us by now know that rates on a 30-year are in the fives. But if you look at the bond market, the mortgage bonds that are trading, you see a little bit of a sideways pattern here. Like we're kind of staying this direction here. Although we're in a very big trading range right here, meaning if the bond wants to stay in this range and go sideways, it can still go up and down. And this movement of up and down in this big trading range really could be 0.25% in rate. So we'd like to see this narrow a little bit and stay up in this range, or of course we would all root for the bond to continue to go this way, because as bond prices go up, rate is coming down. Simplest way to read this chart is red is a bad day, green is a good day. We want to see a lot of green because green is a rising candlestick in this pattern, and a rising bond equals a lower rate. So the one thing we've noticed that I haven't said really with any consistency since I've been doing these updates is it looks like we're trying to find a bottom here for rates to actually stabilize. Okay, and from there, we're going to take our cue from the technicals, which is, understanding how to read what I'm showing you on this chart, and news that comes in. So when it comes to news, we're talking about what's happening in Russia, Ukraine. We're definitely talking about inflation. We know that the Fed who can control short-term rates, is going to continue to hike short-term rates, and they're doing so to slow the economy down on purpose and have inflation come back down. And as I say week to week, inflation is the kryptonite to the bond market. So if we can get inflation under control, we can get mortgage rates under control and possibly down the road see them come back down again. So although we're in the fives, it is not the end of the world. I know 5 seem high because we were at 3 before, but 5 also seems low because I remember when we were in the 7s or 8s, and some people that'll go back to the 80s will tell you they remember it being 12 to 18%. So mortgage rates in the 5s is not the end of the world. It's still pretty cheap money. All right, I know some people, it is driving some people's affordability down, and it is pushing some people out of the market. I do understand, I do get that. But in reality, for many of us, 5% really shouldn't be the end all or be all for wanting to not buy a home right now, especially because you probably won't have this mortgage for 30 years. Yes, we're unhappy that we might have to sell now and lose the good rate that we have, but we're just going to go and refinance down the road when rates come back down again. We've seen these cycles before, and we know that people will refi when rates come down. It will save you money, lots of money, and it's probably worth doing if you're going to be in the property for a while. Okay, so I will get off my soapbox here and let you know that, look, rates are, in summary here, rates are trying to find a bottom, trying to see if we can stabilize here in the low 5s, low to mid 5s. And if we can get that stabilization, and if the Fed can continue hiking their short-term rates, which do not correlate to long-term rates rising, okay, you have to understand that. Fed hikes don't always mean mortgage rates are going to go up. In fact, sometimes and many times, the opposite will happen, and there's a logical reason for that. It's because the Fed is trying to stay ahead of inflation, which they haven't done a good job of. Now they got to hike their rates aggressively to slow the economy down and have inflation hopefully come down. And if inflation comes down, typically the bond market will react positively and price will go up and rate will come back down. That's what we want to see. Any questions? All right, please feel free to comment below or reach out to me directly. Be happy to answer them. But for now, know that this is where we're at, hoping for this sideways pattern. I will come at you next week and let you know if we're doing good or if we've reverted back to possibly a pattern that we don't like. So, hope to see you next week. Have a great day.